A tree is known by its fruit, but a plant is proven by its outcome. You know, I like that saying because it reminds me that our results always show how well we plan. When it comes to selling a rental, your exit plan is the roots. The stronger they are, the sweeter the harvest. Hi, I'm Mia. I have spent 15 years helping landlords and small investors save money on their taxes. Today, I want to talk about how the Big Beautiful Tax Bill of 2025, also known as TO35, shapes the way you sell and how to walk away with more of your hard-earned equity. Quick note, this is for education only, not personal tax advice. Alright, let's take it step by step so it feels like a conversation across the table with the beautiful Colina Beach background. First, let's start with what most sellers worry about, which is capital gain. So nothing new is scarier than a big tax bill after the sale. But the good news, the Big Beautiful Tax Bill, kind of naming the same, right, didn't raise the rate. So they still keep the same capital gain rate, the 0%, the 15%, and the 20% for long-term gain. So that means you own the property for a year or more, you get the long-term rate. What did change is the income threshold. They are now permanently adjusted for inflation. So that means more of your gains stay in the 15% zone instead of jumping to the 20%. Let's share Emma and Carlo's story. They sold a rental this spring and expected to hit the 20% bracket. But because the threshold moved up, they stay in the 15% band and save about 18 grand in federal tax. So that's vacation fun right there, right? So you can enjoy beautiful Hawaii. So when you are planning yourself, you want to look at the overall income. Even moving the closing date by a month could keep you under the next bracket. Now let's transition to the second piece, which is depreciation recapture. So think of this as the IRS asking for a small slice of what you already deducted. So over the years, you claim depreciation to reduce rental income, which is great. But when you sell, they want some of that back. So that is called recapture, and it's taxed at up to 25%. So the TLB3 did not change that. So let's look at Michael Duplex, which is a good example. So he bought it for $300K and claimed $60K in depreciation and sold it for $500K. So the $60K is recapture tax at 25% and the rest of the gain is as his capital gain rate. So he kept receipt of about 15 grand in upgrades, which raised his basis and lower his tax. The small detail but big impact. So the takeaway, know how much of your gains come from recapture and keep every receipt of capital improvements. Next up, let's move to something a lot of landlords love, which is 1031 exchange. Here's a simple idea. So you want to sell a rental, buy another one that's equal or greater value within a set timeline, and you defer paying any tax today. So Sarah did that perfectly. She sold her $600K rental in Denver and bought a $900K multi-unit in Austin. Because she followed the rules, she deferred the $180K in taxes. So that $180K still growing for her instead of sitting in Washington in Uncle Sam's pocket. So if you are plan to stay in real estate, this is the IRS way of saying keep investing. Just remember, you have 45 days to identify the new property and 180 days to close. Speaking of reinvesting, let's talk about opportunity zone. If 1031 is about deferring, opportunity zone is about deferring and reducing. So under TLB3, OZ, which is opportunity zone, rules are now permanent. It was set to expire before, but now it's become permanent. You get a rolling 5-year deferral and a 10% basic bump after 5 years. You hold the investment for 10 years and any new growth is tax-free. Let's say an example, Rebecca used this after selling her Atlanta rental. She rolled $250K into an OZ fund that was about building affordable housing. So after 5 years, her cut of the $25,000 of her taxable gain and still keep earning returns. So if you believe in community projects or want to diversify, this is a great blend of doing good and saving taxes at the same time. Now let's shift timing, right? Because when you sell is as important as how you sell it. So Tom had two rental in Florida. He knew his business income would spike in 2028. So he sold one in 25 while rates were low and held the other until he could offset with losses. So by spreading sales across years, he kept himself in lower brackets. That's why I call 2025 through 2027 is a sweet spot, because rates are low, 1031 is safe, and you still have flexibility to plan before future rules phase out. And don't forget state taxes. Even if you win at the federal level, states like California, Hawaii, and New York might take a big slide because they tax capital gains as ordinary income. Lani in California sold her rental and got hit with state tax on top of federal. So she worked around it by splitting her deal, part 1031, part installment sale, so she didn't pay everything in 1 year. That move cut her total bill almost in half. So let's plan for state rules too. They can make or break you after tax profit. Now let's walk through some creative exit options you might not have considered. An installment sale. So you finance the buyer, collect payments over time, and report gain gradually. So that spread tax and keep you in lower brackets. Converting to your primary residence and leave it in it for 2 out of 5 years, and you can exclude up to $250K for single and $500K for married of the gain. Charitable remain the trust. You can donate the property into a trust, get income for life, and avoid an immediate tax hit. You can do partial sales or lot split, so sell just part of a parcel or reinvest the gain portion into a 1031 or an OZ fund. You can also hold it into debt, so your heir get a step-up basis and your recapture vanishes. Every option connect back to your opening idea, so the strength of your plan determines the fruit you harvest. Before we wrap up, let me leave you with a few bonus tax moves. If you got stock or crypto in loss positions, you can sell those to offset your gain this year. You can bundle improvements before sale to raise your basis. Check for energy credit. They can still apply for rental upgrades. And if you have passive loss carry forward from a prior year, the sale let you finally use them to offset income. So let's bring it back to the proverb. A tree is known by its fruit, but a plan is proven by its outcome. If you build your exit plan with intent, choosing when to sell, how to defer, and where to reinvest, your fruit will speak for itself. If you want a simple way to run your number, you can check out our rental sale and recapture planner at ProDeduction on Etsy. And for deeper learning, you can visit accessyinstitute.com. And if you are thinking about selling in 2025 or 2026, you can comment sell below, so I know you are part of this wave of smart exits. Because at the end of the day, the plan you build today is the fruit you will harvest tomorrow. Thank you for watching. I'm Mia. I see you at the next video.